Good afternoon, folks, and happy Friday, and welcome to this week's version of Weekly Commentary. So Wednesday of this week, markets soared with the S&P 500 and NASDAQ reaching brand new highs. Driving force behind the rally was a social media post, numerous posts by the president, saying that the war would soon be over, that the Strait of Hormuz would reopen, and that we would declare victory and go home. Well, we'll see. Because meanwhile, the Iranian regime likely is scratching their heads over the president's post, wondering why nobody told them the war was over. Iran's public stance remains as defiant as ever. At the same time, Iran has flooded social media with AI-generated propaganda, now being called slopaganda, with much of it consisting of these Lego-style animations mocking Trump, the United States, Israel, and the Prime Minister of Israel, Benjamin Netanyahu, while at the same time portraying Iran as bravely resisting a weak and morally decaying West. The objective is clear for them, and that is rally the population, shape perception, and discourage thoughts of uprising against the regime. But propaganda can only go so far because severe restrictions, shortages, and visible destruction are becoming increasingly difficult to hide. My hope, and I think the more likely reality, is that this public defiance is more about helping the regime possibly stay in power and not be overthrown, while its private negotiating stance is more accommodating. Again, we'll see, but if the current status quo continues for a few more months, the Iranian economy could and likely would fall into chaos, the type of which could take a generation or more to recover. So while investors appear to be unconcerned at the moment about the conflict, it does still remain as the one major potential headwind to the economy and the markets, one that still poses the risk of pushing the global economy into recession. And at this point, it's a waiting game. We'll see what happens this week, but it's been a waiting game, almost a game of chicken. What will happen first, the global economy being pushed to the edge of recession, or the Iranian economy plunging into generational destruction? Well, hopefully we have a satisfactory outcome achieved soon. Because while markets were encouraged by the president's post Wednesday with Iranian pushback, markets sold off on Thursday. Today, however, we're back to strong rally mode as investors do appear to be looking past the war. And also, it's very difficult for investors to ignore the extraordinary earnings from the first quarter. 84% of companies reporting so far have beaten earnings per share estimates, most by a wide margin. More impressive is how much future guidance has beaten expectations. Those expectations now sit at a 27% growth rate versus the 13 to 14% expected going into earnings season. So stocks, especially those in the tech sector and most spectacularly those in the chip industry, have skyrocketed. This market reaction is now bringing out yet more comparisons to the dot-com bubble of 26 years ago, with many suggesting that, based on charts, we are currently looking like we did in October of 1999. While I strongly disagree with that, it's at the same time worth noting that equities rose on an average another 40% before that bubble burst in 2000. Many caution that those who believe this time is different invariably get burned, and I do agree with that when comparing similar phenomena. But there is no this time. There has never been a time like this. While charts may look similar to 1999, conditions couldn't be more difficult. Earnings are growing rapidly, not contracting. Valuations are declining, not rising to the moon. Stock prices in most cases are growing on the back of positive fundamentals, not hope and hype, as was the case back in 1999 and early 2000. During that era, investors anticipated that the internet would propel earnings across the economy to record levels. On that basis, with the optimism around AI currently, there things do look somewhat similar. However, back then there was no evidence whatsoever that the previous brand new, slow-moving technology was going to produce results anytime soon that would come anywhere near justifying valuations that at their peak were double the historical average. Today, AI is a much more rapidly developing technology, and it is producing meaningful results now. While expectations are high for future earnings, likely those expectations are justified. The results of some companies recently, like SanDisk, they are a data storage company manufacturer. They are continuing to give rise to these comparisons. Now, while it's true that SanDisk's stock price has experienced almost absurd growth, gaining 540% so far this year and 4,000% over the past 12 months, the similarity with some of the high flyers during the 1990s ends there. Why? Because revenue and earnings at this company have grown faster than the share price. Based on forward earnings expectation, the stock currently trades at a multiple of less than 21. And that's low for the tech industry and lower still for the chip industry. And in fact, currently it's lower than the PE on NVIDIA. Cautionary tales are likewise being made using another kind of high flyer, Micron, as an example. From its peak price back in, of $93, I should say, back in early 2000, Micron collapsed 93% to about $6 in early 2003. But conditions for Micron are very different today. The company then was really a memory chip maker, which was essentially a high cyclical commodity. Well, a glutton supply formed, demand collapsed, and that, along with a collapse in pricing, led to this 93% sell-off. Today, high bandwidth memory, it's a bottleneck with demand far exceeding supply. The technology today and the prospects for growth are greatly different than they were 26 years ago. The total addressable market, the TAM, is in the trillions for many of these companies as opposed to billions a couple decades ago for the whole industry. One final point regarding the differences between this era and the dot-com bubble is how much people are talking about a bubble today and how cautious many are as a result. There was little talk about a bubble in the previous era, and caution was thrown to the wind. By the way, I'm using the above companies simply as examples of high flyers and the differences. I'm not recommending them, just examples. And then in addition, when brilliant minds like Jensen Huang, who is the CEO of NVIDIA, say that we're in a new industrial revolution that will impact every industry, company, and country, driving a multi-trillion-dollar infrastructure opportunity, I listen. He has recently predicted that this revolution will produce 4 times as many millionaires as the internet era. Now, I don't want to overhype the impact on AI on revenue, earnings, and the markets, and I'm not suggesting that hyper growth in any of these companies or in the industry is sustainable. In fact, some of these areas are setting up for a pullback, which is normal in markets. But I do want to suggest that comparisons to the dot-com bubble and bust are kind of silly. Current valuations and realistic expectations suggest that at the least the market is sustainable at current levels and not setting itself up for any kind of early 2000s type of crash. So until growth is no longer justifiable by the fundamentals, I don't believe we're close to a bubble. We are certainly going to keep an eye on those fundamentals for any signs of concern. As well, we're going to remain vigilant to any potential threats to the economy, markets, and hot new industries such as the AI revolution. And we will, as always, keep you apprised as best we can. So until next week, have a wonderful weekend.